Most people fail at long-term investing not because they lack intelligence, but because the process quietly conflicts with human nature. Patience, emotional control, and delayed gratification are required, yet daily life rewards speed, reaction, and constant stimulation. Long-term investing demands trusting outcomes that are not immediately visible. This creates discomfort, as progress often feels slow or non-existent during the early and middle stages, even when the approach is working as intended. Many investors underestimate how strongly emotions influence decisions. Fear during declines and excitement during rallies often override carefully planned strategies, leading to actions that contradict long-term goals. Short time horizons are one of the biggest obstacles. When investors focus on weeks or months instead of years, normal volatility feels like failure rather than an expected part of compounding. Another common issue is unrealistic expectations. Many enter investing hoping for consistent gains, unaware that uneven progress and temporary setbacks are the norm, not the exception. Impatience quietly erodes discipline. When results feel slow, the temptation to change strategies increases, even though frequent changes often reset progress rather than improve it. Long-term investing also requires boredom tolerance. Long stretches of inactivity test confidence, causing many to seek action simply to feel productive. Many people confuse activity with effectiveness. Frequent buying and selling feels like engagement, but often increases mistakes, costs, and emotional stress. Avoiding discomfort is another hidden problem. Long-term success requires enduring uncertainty, yet many abandon sound plans at the first sign of unease. Comparing results with others intensifies frustration. Seeing others appear successful creates pressure to chase strategies that may not align with personal goals or temperament. Another reason people fail is lack of clear rules. Without predefined guidelines, decisions are made reactively, driven by headlines rather than long-term reasoning. Overconfidence during good periods is equally damaging. Success can encourage riskier behavior, increasing exposure just as conditions begin to change. Many investors underestimate risk because markets feel stable for long periods. Stability creates false confidence that disappears quickly during downturns. A misunderstanding of volatility also causes failure. Price movement is often mistaken for danger, even when underlying businesses remain strong. Fear of loss weighs heavier than satisfaction from gains. This imbalance pushes investors to exit positions prematurely, sacrificing long-term potential for short-term relief. Long-term investing rewards consistency, but inconsistency is common. Skipping contributions or changing plans disrupts the compounding process. Another obstacle is poor preparation. Many investors enter markets without understanding their own tolerance for uncertainty, discovering limits only during stress. Ignoring personal temperament leads to poor alignment. Strategies that look good on paper may fail emotionally when pressure increases. Many people rely too heavily on predictions. Forecasts feel comforting, but dependence on them often leads to disappointment and reactionary decisions. Long-term investing also requires humility. Accepting that outcomes cannot be controlled reduces stress and improves decision-making. Another common failure is lack of reflection. Without reviewing past decisions, mistakes repeat quietly over time. Overtrading increases friction. Fees, taxes, and errors compound negatively, even when individual decisions seem small. Emotional spending habits often spill into investing behavior. Impulse-driven decisions in daily life translate into impulsive financial choices. Many people avoid learning during difficult periods. Discomfort discourages engagement, even though downturns offer valuable lessons. Ignoring opportunity cost slows progress. Capital tied up in weak ideas cannot support stronger opportunities later. Long-term investing requires alignment with life goals. Without clarity, money decisions become scattered and reactive. Another issue is seeking certainty. Waiting for perfect conditions often results in missed reasonable opportunities. Failure to plan for downturns increases panic. Preparation replaces fear when markets become unstable. Finally, many people underestimate the time required. Compounding works slowly at first, testing whether patience can outlast doubt. Another reason people fail is reacting to headlines. News is designed to provoke emotion, not support long-term decisions. Yet many investors allow daily narratives to override carefully considered plans. Market noise creates urgency. When every movement feels important, investors feel compelled to act, even when doing nothing would better serve long-term outcomes. Many investors lack a clear definition of risk. They focus on short-term price swings while ignoring the deeper risk of abandoning sound strategies at the wrong time. A common failure is misunderstanding ownership. Stocks are treated as symbols to trade rather than partial ownership in real businesses with long-term earning power. Long-term investing requires trust in process. When results lag, expectations, doubt creeps in, tempting investors to abandon strategies just before they begin to work. Another obstacle is lifestyle inflation. As income grows, expenses rise alongside it, leaving little capital available for long-term investing consistency. Many people chase performance. Buying what has recently done well often leads to entering at inflated prices, increasing the likelihood of disappointment. Loss aversion intensifies poor timing. Investors often sell during declines to avoid pain, only to miss recoveries that follow periods of fear. Another issue is lack of financial buffers. Without emergency reserves, investors are forced to sell at unfavorable times when unexpected expenses arise. Long-term investing also suffers from comparison bias. Measuring progress against others creates dissatisfaction and encourages unnecessary changes in strategy. Many people fail to define success clearly. Without personal benchmarks, progress feels insufficient even when plans are working as designed. Another reason is neglecting simplicity. Complex strategies are harder to follow consistently, increasing the chance of emotional errors during stress. Overexposure to risk is often misunderstood as confidence. Concentration without understanding increases anxiety and magnifies mistakes. Long-term investors must accept uneven progress. Extended flat periods test belief, even though they are normal within long-term growth paths. Many fail because they treat patience as passivity. Waiting is an active decision that protects capital when conditions do not justify action. Another obstacle is inconsistent saving behavior. Sporadic contributions reduce the power of compounding and disrupt momentum. Emotional fatigue also plays a role. Constant monitoring drains mental energy, making disciplined behavior harder to sustain over time. Many investors underestimate the importance of alignment. Strategies must fit lifestyle, goals, and temperament to remain sustainable. Another failure comes from ignoring opportunity cost. Time and capital spent on weak decisions limit exposure to better options later. Long-term investing demands resilience. Temporary setbacks are unavoidable, but many abandon plans rather than adapting calmly. Many people fail because they seek excitement. Investing rarely feels thrilling when done correctly, which makes it easy to abandon. A lack of education compounds errors. Without understanding basic principles, decisions rely on hope instead of judgment. Another reason is avoiding responsibility. Blaming markets prevents learning and reinforces repeated mistakes. Long-term success also requires review. Regular reflection improves behavior more than constantly searching for new strategies. Many investors fail by underestimating fees and taxes. Small costs accumulate quietly, reducing long-term outcomes. Another problem is anchoring to past prices. Emotional attachment to entry points interferes with rational decision-making. Long-term investing requires letting go of control. Markets cannot be forced to cooperate on personal timelines. Many people fail because they expect comfort. Discomfort is the price paid for long-term returns. Finally, failure often stems from impatience disguised as ambition. True progress favors endurance over urgency. Another reason people fail is mistaking confidence for discipline. Confidence rises during good periods, but discipline is tested only when conditions feel uncomfortable and outcomes remain uncertain. Long-term investing requires accepting delayed feedback. Decisions made today may not show results for years, making it difficult to know whether patience or stubbornness is being practiced. Many investors struggle with regret management. Looking back at missed opportunities creates emotional pressure to overcorrect, often leading to decisions driven by frustration rather than reason. A lack of personal conviction also contributes to failure. Following ideas borrowed from others weakens resolve when markets test belief and confidence fades. Long-term investing demands emotional independence. Relying on reassurance from others often leads to abandoning sound decisions at the wrong time. Another failure point is ignoring downside protection. Preserving capital during difficult periods matters more than maximizing gains during favorable ones. Many people underestimate the importance of survival. Staying invested through multiple cycles requires avoiding decisions that permanently end the journey. Failure also comes from chasing complexity. Sophisticated strategies promise control, but often increase errors when conditions change unexpectedly. Long-term success favors those who remain selective. Saying no to most opportunities protects focus and reduces exposure to unnecessary risk. Another challenge is resisting narrative bias. Stories feel convincing, but markets often move independently of popular explanations. Many investors fail because they expect linear progress. Long-term results arrive unevenly, often after extended periods of frustration or stagnation. Emotional discipline weakens under stress. When pressure rises, even well-designed plans can be abandoned without strong behavioral foundations. Another reason for failure is neglecting review during calm periods. Reflection during stability prepares investors for inevitable turbulence. Long-term investing also requires accepting limits. Knowing what you do not understand prevents costly mistakes fueled by overconfidence. Many people struggle with identity attachment. When self-worth becomes linked to outcomes, emotional reactions intensify and discipline weakens. Another failure comes from reacting to short-term losses. Temporary declines are often misinterpreted as evidence of flawed strategies. Long-term investing rewards humility. Accepting uncertainty reduces the urge to control outcomes that cannot be controlled. Many fail because they confuse movement with improvement. Change feels productive, but consistency often delivers better results. Another issue is ignoring compounding's timeline. Early progress feels insignificant, testing whether patience can outlast doubt. Long-term success depends on aligning behavior with goals. Misalignment creates tension that eventually breaks discipline. Many people fail by avoiding responsibility for decisions. Ownership encourages learning, while blame encourages repetition. Another obstacle is emotional exhaustion. Constant vigilance drains energy needed for long-term consistency. Long-term investing requires the ability to remain calm when others are not. Collective fear amplifies mistakes for those who follow it. Many investors fail because they seek certainty before acting. Waiting for clarity often means acting too late. Another challenge is resisting comfort-seeking behavior. Comfort often conflicts with decisions that build long-term wealth. Long-term investing also demands acceptance of boredom. Quiet periods are not failures but necessary phases of growth. Many people abandon plans because they underestimate endurance. Success often belongs to those who simply stay the course longer. Another failure is focusing on outcomes instead of behavior. Behavior is controllable, outcomes are not. Long-term investors must accept emotional discomfort as normal. Discomfort signals participation in the process, not failure. Many fail because they forget why they started. Reconnecting with purpose strengthens resolve during uncertainty. In the end, most people fail at long-term investing not due to lack of knowledge, but because behavior breaks before time is allowed to work.